only way you can really justify it is if you can get your payback really fast. I mean, and I guess it depends how you define low cost too. If it's bottom, if it's not, if you're in the middle of the cost curve, that's not necessarily low cost, because it really depends on how long you think the current market might last or the like. But if you're talking about a company that's barely squeezing out margin right now, it becomes tough, because even though it may look cheap on a hypothetical earnings basis and all this, if costs go up a little bit more, all of a sudden you have no margin left. So you've got to make sure that if you go through with something like this, that you can survive the bump, you can survive some reasonable bumps along the way. So I'm not a big believer in the long-term cost curve, because the reality of the situation is it's not about the long-term cost curve, it's about the cost curve in the next 5 years. And most of the projects that are talking about the long-term cost curve will not see the light of day in the next 10 years. So you need to figure out whether your project can survive in something in a market that's, say, a 20, 30, 40% decline from today. You don't need to worry about how you're going to look in 30 years. It's just not. That's just not relevant really for present day analysis. But you need to be able to survive. And in a diverse environment. If you can't do that, then I think investing in a company like that, it just becomes very challenging.